COVID-19 on various real estate asset classes panel. During the next 50 minutes or so, you will hear from accomplished investment professionals about the direct and indirect impact of COVID-19 on various real estate asset classes. We will discuss the balancing act of meeting short-term requirements to help slow down the pandemic versus maintaining long-term viability of operations and investments. And the panelists will also provide their views about the outlook of real estate investment market and potential opportunities. Okay, we hope to make this an interactive session, so please don't shy away from submitting your questions. Any questions that we don't get to answer right away, we will answer at the end of the panel during a roughly 10-minute Q&A session. Okay. Again, my name is Eduardo Alves. I'm a director in the Credit Risk Solutions Group of S&P Global Market Intelligence. My team provides the tools that credit and investment professionals rely on to make risk assessment, underwriting, and pricing decisions with conviction. Our commercial real estate scorecard is a powerful credit risk and investment tool for both in construction and income-producing commercial real estate, be it multifamily, industrial, residential, retail, office, constructions, hotel, you name it. My background is in credit risk, stress testing, commercial loan origination, consulting, and econometric research. It's my pleasure to moderate today's panel and introduce you to our fantastic lineup of panelists. So please join me in welcoming Lisa Forster, VP from Group RMC, Eric Perman, CIO for Afar, Camilo Nino, CEO and founder, LinkBased Capital, and Renato Buchholz. Renato, you might have to correct my pronunciation of your last name. Co-founder and partner for Garim Investimentos. So now I invite each one of the panelists to take a minute to introduce themselves and their companies. Perhaps Eric, you go first.
Sure, thanks Eduardo. Hi everyone, happy to be here joining the panel today. So Afar, our group is a boutique real estate investment and development firm. We also have a hospitality operator that we operate our hospitality projects with. At the moment, we have projects actively in Colombia, Puerto Rico, and Portugal. We sponsor syndication deals in the range of about $15 to $30 million, so on the boutique end, and different asset classes we'll invest in would be boutique hotels, multifamily, mixed use. We also do pre-sold condo developments that are geared towards tourism and the short-term rental market. The investment strategy we like to follow is more of a value add or opportunistic. We like to find assets that have strong cash flow potential in prime locations that are underperforming at the moment. We also have a distressed asset deal on the books. And in Puerto Rico, we run a single asset. We run qualified opportunity funds, if anyone's familiar with opportunity zone investing and the Tax Cuts and Legislation Act. So there are a lot of tax benefits and incentives to investing in zones, and we take advantage of that here.
Thank you, Eric.
Sure.
Camilo?
Thank you, Eduardo. Thank you, Mike and Marcelo, for inviting us. Great webinar. LinkBased is an alternative co-investment platform. We focus on alternative co-investment opportunities. We develop products non-related to the markets, and we invite normally family offices, multifamily offices, and high net worth individuals to co-invest with us in each opportunity. We are not a fund. We do deal by deal. We have a deal by deal structure, and we have three different kind of products, if you want to call them. One is bridge lending through LB lending, LinkBased lending. We create an entity. There is a mortgage lender registered under the state of Florida, and we focus on doing short-term bridge loans for any kind of projects that have real estate collateral, from land development, land entitlement, construction, acquisition of assets, repositioning of assets, any kind of asset-based loan that we like the property and understand the sponsor's plan, we can finance them. And normally we sell the investors to the loans to our investors, and we do the servicing during the whole cycle of the loans. Second product that we do, we acquire commercial properties through LinkBased properties, typically triple net assets, properties rented to banks or to, I don't know, companies like McDonald's, for example. And in those kind of investments, typically we are looking for locations, some cash flow, and if we need to, we have covered land plays where we can reposition the asset down the road and create value on each of those opportunities. And finally, and actually this line is also created because of the lending platform that we have, we co-invest with developers in multifamily projects, developers that we met through the lending platform, but that we like what they do, we like their experience, and we end up partnering with them in the equity side to develop multifamily projects in Florida. So those are the three kind of products that we offer in the US. I'm originally from Colombia. We are based in Miami. We have offices in Colombia and in Miami. And we are in the process of developing a bigger platform from US or international investors, because we started working a couple of years ago, almost 10 years ago. And our main base of investors is from Colombia, but we've been developing and growing in the US in the last 2 or 3 years, and that's our goal now.
Thank you, Camilo. Appreciate it. Hey, Lisa.
Hi, everyone. Hi. Thank you so much for having me on the panel. I'm super excited to be here. So my name is Lisa Forster, and I am a vice president on the Family Office and Advisor Relations team at Group RMC. Group RMC is a long-term focused real estate investment group, and we focus on low prices and great values. So in the past decade, the segment we've been able to find these types of opportunities has been office properties in non-gateway markets, which include big office portfolios and office towers. So we're buying high income producing office properties, and we offer co-investment opportunities. So we're partnering with other family offices from around the world, RIAs and individuals on direct deal by deal opportunities, and we also have an open-ended fund vehicle. So we've accumulated over 17.5 million square feet across 12 states, mostly in the Midwest and Southeast, which gives us an interesting perspective and interesting data, especially given the times. We're some of the largest landlords in Kansas City, Memphis, Columbus, Ohio, suburban Chicago, Indianapolis, and more. So thanks for having me.
Great, thanks, Lisa. Very curious to talk about your portfolio. Renato.
Hi, everyone. Thanks for the invitation. I'm a partner and co-founder of Garin Investimentos. We are a boutique investment firm in São Paulo, Brazil. And we mainly have 4 areas of business. We have the asset management, which are local hedge and equity funds locally in Brazil. We have the wealth management, where we do the management as a multifamily office, and we do it locally in Brazil and also offshore. And we have infrastructure, which is like in the infrastructure we do consulting, and also we organize projects and try to develop new projects, mostly in greenfield. And also venture capital, which is also, we do advisory for companies that are trying to get into the market. And also we do some co-investments with startups. And that's all.
Great. And you didn't correct me on the last name pronunciation, so I hope I'm
Yeah,
right.
it's Buchholz. It's fine.
Thanks.
Thank you.
Well, thanks all four of you for joining. And Mike just mentioned, I mean, this really is a once lifetime event because we live in extraordinary times right now. You know, all real estate property types are affected one way or another by the COVID-19 pandemic. The S&P Global Ratings research, you know, indicates that multifamily, industrials, and data centers, they appear to be more resilient, right, in the current environment. Meanwhile, retail-oriented assets, particularly malls, look set to suffer under the decreasing rental payments and severely impacting their cash flows. Well, to put this into perspective, last April, right, the average rental collected in percentage terms was in the mid-90s for rental housing, 60% for strip malls, and down to only 20% for regional malls and outlets. Okay, so the long-term future of office buildings is also slightly uncertain, and we'll hear certainly from Lisa about that, as social distancing rules and increased work mobility puts downward pressure on demand for office space. Our expectation is that the lease renewals will be marked by very tough renegotiations. These are global trends, not something observed only in the US or European markets, but all over the world. Okay, so against this backdrop, let's hear from our panelists about the impact of COVID-19. And Lisa, I would love to start with you. You know, as one of the largest private office landlords in the US, can you tell us about the impact that COVID-19 has had on your portfolio?
Yes, absolutely. Happy to kick things off. So for the past 3 months, well, actually now we're in July, but March, April, May, we've collected 97% of rents. In June, we were at 96%, and for July, we've collected 95% so far, and of course that can continue to go up. So the vast majority of that 3 to 5% that has not been collected will be recouped in the next 12 to 24 months. It is deferred rent, not forgiven rent. So our asset class and our category has been quite resilient. One thing that is really important to emphasize is that not all real estate revenue is the same, as we've seen, especially in retail and hospitality. You know, some of those stats that you were just saying before I started speaking. This is really a testament to the strength of our revenue and having high quality income, because we're essentially a creditor to thousands of corporations. We have over 2,000 tenants across 200 buildings, and that's always been one of our key disciplines, to diversify and mitigate tenant concentration risk. And we only are buying multi-tenanted office buildings. That's all we own. But within basically from the trenches, we do have a few different observations with regard to leasing activity, which really is the heart and soul of our business. The first being that we actually saved a lot of tenants that were maybe going to move out or relocate during the pandemic. So what we've seen is tenants who are actually looking to maybe upgrade their space or go into brand new shiny spaces that were 30 to 40% more expensive decided to forego those plans, which has been really good for us. We have high quality space at good value and pricing for tenants, which really helps at a time like this. We've also signed many as-is rent renewals, more than we ever have in the past. So you might be wondering, what is an as-is renewal? So that's when tenants sign for additional years on their lease without the landlord, in this case Group RMC, having to put more money in for tenant improvements. So this has the best landlord economics. Another interesting thing to note is that the occupancy for our entire portfolio is actually 50,000 square feet leased more in May 2020 than it was in December 2019. So obviously that's not a huge amount, and there is an element of variability, but there's clearly not a trend in the other direction. Also, our leasing activity and quality of new leases signed has been solid. We've not had to bring down rents in any market that we're in. Everything has stayed market rent. We haven't even pushed back in including bumps in rents year over year in new leases. So this leasing activity we've seen is not the trend for all real estate segments and markets, but in our specific niche, that is what has been going on. Also, Group RMC is the largest third-party client of CBRE property management in the nation. We use the best-in-class property management and leasing teams in every market we're in. We're not vertically integrated. And this is really a huge advantage for our group because all of our properties are professionally managed and follow CDC guidelines. Every market is different in terms of timeline of getting workers back to the office, but we are well equipped with regards to giving tenants the tools, protocols, and the best-in-class asset management. Because best practices are always used in the national programs, this is not a mom and pop type of operation, which gives our tenants a lot of comfort.
I mean, that's incredible performance, that you're being able to maintain given the situation, especially given also the numbers that I just mentioned, right? That, especially for the office space that has suffered tremendously. So, fantastic work on that front. Eric, perhaps you like to talk about the impact of COVID in your portfolio.
Yeah. So we have a couple of projects in acquisition mode, and we have another one in full-blown construction. So I'll give a bit of a two-sided perspective. We have a project in construction in Old San Juan in Puerto Rico, 60-key boutique hotel, full service. And the impact that we had from COVID was really just a time delay. We've already syndicated and fully raised the capital. We're not drawing on loan funds during COVID, so we don't have any interest expense. But the governor did completely shut down business here for a couple of months, and that included construction sites. So we pushed everything back. We lost a little bit of time. But the silver lining in it is that now you wouldn't really want to open and launch a brand new hotel inside of 2020 because you're going to be dealing with much lower occupancy and demand. So now we're looking at, whereas we were originally targeting to open at the very end of this year, we're going to look towards probably spring of 2021. So it's kind of set us back time, but we didn't lose any money. We didn't incur extra costs. So it wasn't the worst thing in the world. We're in a much better position than a lot of operating hotels who had to furlough a lot of their staff and deal with cash flow constraints. We have another project here, and similar, we have a project in Portugal in acquisition mode. One is a distressed asset. The other one is an operating hotel. The distressed asset, because we're syndicating the capital, there was definitely a kind of a pause. We didn't have much interest from investors. I'd say for about a month to a month and a half, people were definitely sitting on the sidelines and they wanted to see how, the pandemic would play out, what would happen to the markets and where investment, demand would return to first. But in the past 3 weeks, we've already had a few new investors commit to the project. And so it's a positive sign that overall people are either looking for certain distressed opportunities with upside to them or are just feeling more comfortable with the way things are going. In Portugal, the property that is operating, we closed it and sent the employees home for, about 2 months. But Portugal also was one of the countries that responded pretty well and was able to maintain their cases of COVID pretty low. As I was just checking today on future reservation activity, and there's already some guests reserving for August, September, but most of the demand is coming from people who can drive. So the local tourism, people from Spain, France, and within Portugal. So I think in the beginning of COVID, there was definitely a total crisis and chaos within hospitality, and it still is very much so. But there are some positive indications that we're seeing, and just trying to stay with a positive outlook and ride those coattails of those good things.
Yeah, and it's very interesting what you mentioned. According to the methodology of how we at S&P look at commercial real estate, we separate the in construction risk, right, versus in operation real estate. And generally speaking, the construction risk tends to be higher, right, than the operations phase of the real estate asset. But it seems that during these very unusual days, right, properties that were already generating cash flow are suffering a lot more than the ones that are still in construction, precisely for the reasons that you mentioned before, right? That you basically lost a bit of time, right? But that a lot of, most of these in construction projects account for a bit of delay, and they have appropriate reserve accounts to maintain that delay. So would you say that, the first project that you mentioned benefited from the fact that it's still in construction and not already in operations?
Definitely. I agree with that wholeheartedly, because, and it varies, of course, case by case. It'll depend on the project and what your capital stack is. I know there's probably a lot of construction projects with a lot of debt stacked on. Our leverage is very low, and so we don't have that interest expense, but I imagine you could use up your reserves pretty quickly if you're highly levered. And certainly in operating properties, like you mentioned, I mean, people have pretty tight loan covenants, and I imagine they're tripping them left and right. So I know there's a lot of restructuring activity going on already, and that'll continue certainly.
Yeah. Renato, how about you? What are you seeing as an impact of COVID?
Yeah, I'm talking in the sense of the point of view as an investor, right? Which as unbiased, let's say, right? So I think there will be two types: the temporary impact, and also there will be some permanent impact. The temporary impact, I think, would be more related to travel and things that, as the economy recovers, we're going to see more things coming back to normal. The permanent impact, I think, it's not for certain. It's obviously we have to see how things are going, but I think there would be some. Many companies, they were forced to have people working at home, and I think that many companies are going to see that there is a pro in terms of cost, in terms of health benefits for their employees. So they might keep some. I'm not seeing like something as like a 90% of an office working from home, but we can see some movement in this area. So I think something that we're not looking at, it's like the big office spaces. I think office they're gonna be around, but I think we're gonna have some smaller spaces. So that's one thing that I think it's gonna be one of the great impacts on the real estate sector, and also something on the shopping malls and strip malls that also could be affected in some permanent way, because people got used to buy online. So also it's something that it's not going to be the whole industry, but there's going to be some reduction on this type of real asset.
Yes.
So I think that's the main thing as an impact on my view.
And as we might even see, of course, retailers themselves choosing different approach to reach their customers versus a big mall, right? So we saw, I believe it was just either 2 days ago or even yesterday, Muji, which is a very large Japanese retailer, filing for bankruptcy in the US, primarily to shift operations away from having many retail, retail stores, to focusing more on their online retail income. So that's something that could certainly impact the malls, like you said.
Yeah, there's going to be a pro for that I'll say later on what we're looking at, but yeah, you're right.
Thank you. Camilo, how about you? The impact of COVID on your portfolio.
Perfect. In the lending side, overall, I think there is a positive impact that we increase the communication with our investors and our partners or sponsors that we work with because of the whole situation. And that increase in communication, I think, is strengthening the relationship and the trust between investors and with partners. And I think that's going to be an advantage down the road when everything gets back to normal, because in difficult times is normally when you know really how people behaves and how professional is your team and how successful is your company executing the business plan. And I think that's a positive result, because you can be prepared, you can run any kind of scenarios, you can think that you are ready for crisis, but until you get them, you don't know how the system and your business model is going to work. So I think a positive impact of all of this is that we are validating that the products that we have can work even during difficult times, that working really close, not as providers or counterparts, but as partners. That's why our purpose is the long-term partnership approach. If we work as partners and strengthen the relationship, even in difficult times, you can figure it out and you can deal with the problems. So for us as a company, and for me as a leader of the company, it's been a really positive impact and a really positive development. Validate our model, validate the professionalism of our group, and the trust of our investors and our partners in the businesses. Another positive thing is that our portfolio of loans, we have close to 200 million in outstanding loans. Almost 90% is performing. And the ones that are not performing are really not COVID related. We had some foreclosures before the COVID. Of course, this whole COVID situation delayed the processes, the legal processes, but overall it's really satisfactory for us that the kind of projects and the kind of sponsors that we are financing are working and are performing under these circumstances. In development, even though we are only in multifamily, and as you, Eduardo, said, multifamily is one of the safest assets to be in. We have 3 projects in starting development, starting the construction, and the 3 of them, the construction loan approvals got delayed. So one of the negative impacts that we've been having, and I have seen this negative impact overall the market, is that the banks, the traditional banks, and even the government through HUD is taking forever to take the decision to do a construction loan. And that delays, of course, the development of the project. But as long as we are in good assets, good locations, good markets, we still believe in the fundamentals of those developments. And even though it's going to be delayed 3 or 6 months, we will continue with those developments, and I'm pretty sure we will be successful on those 3 projects. But it's a negative impact having to delay the projects because of the construction loan appetite from the banks. Mm-hmm. And another impact that we are having is that because it's difficult to measure risk right now in the lending side, and it's difficult to understand or foreseeing the impact that all this crisis is going to have on the different prices of the asset classes that we do loans on. We decide to reduce the loan to value from 60, 65 to 50%, and that is reducing the loans that we can originate every month, because sponsors are still looking for high leverage, and we decide to reduce the loan to values on any loan that we offer and any term sheet, and of course that is making that is slowing our growth, and that is making really difficult to be attractive for lenders. But we'd rather be wrong in the conservative side, and if the market doesn't correct as we expect, we rather increase in the next 3 or 6 months the loan to values than do loans that today look okay, but maybe in 3 or 6 months look too aggressive. So that's a negative impact, but we rather go in the we rather play in the conservative side.
Thank you, Camilo. And for the attendees, like I said, please feel free to submit questions, okay? We will get to them either straight away if it's pertinent to the topic at hand, or we'll save them to the end. So if we shift a little bit now from the direct impact to something more of a strategic adaptation of operations of your firms, you know, Camilo, you already mentioned a little bit you know, the loan to value change, you know, basically making your underwriting, just tightening the standard a little bit for your underwriting. I'll turn the question to Eric. You know, have you changed, or are you required to change, or do you expect to change any of your strategy of operations for the company, and maybe you can talk a little bit about also the niche you carved out in Puerto Rico.
Yeah, so we don't contemplate any change in core strategy. Hospitality in general, I mean, once you're open and operational, I do think there will be a lot of changes from the operational perspective, and we'll talk a little bit more about that, I think, coming up. But you know, Camilo's point is relevant about the credit tightening as well. That's having an impact. And so, you know, I guess leverage is a good point to consider in terms of changing strategy with your capital stack. But here in Puerto Rico, we're running, I mentioned the 2 projects, and both are actually structured as a single asset qualified opportunity fund. So investors that are investing from a high level, I'll just give a brief overview, but investors investing capital gains can defer your tax liability for up to 8 years. You can get a step up in basis now of 10%. And then when you make the investment, if you hold it for 10 years, you're actually exempt from any future capital gains on the investment itself. So, you know, you put in $1 million of cap gains into an investment portfolio here, into a project, and it appreciates, you exit for $2 million, you don't owe any tax on that. So there's a lot of people investing in op zones around the mainland US. I guess the prime advantage that we have here is that you're on a Caribbean island, and we actually have assets that are in the center of a UNESCO World Heritage Site in the Old San Juan. We have another one that's right on the beach on the west side of the island. And so you have assets that are prime attractive tourism destinations, which gives you definitely an edge to the locations of many of the op zone projects around the continental US.
Thanks, Eric. Lisa, how about you? So how, you know, what lies ahead in the future office, and how is this going to impact your strategy?
Yeah, of course. So we have weathered the storm very well so far, but this is undeniably the most asked question that we get during this time, especially since everybody, I'm sure even on this call, has been forced to work remotely during the pandemic at some point. So there is some truth to some of the themes you hear, but they do require some nuance as you analyze the various theories. So the most prevalent theme is the whole work from home concept. So it is important to note that not all work from home analysis is positive, and not everyone is receptive to 100% of the time working remotely. Actually, a recent Forbes article published in May stated that 95% of Gen Z workers and 93% of millennial workers admit that they're having a hard time working remotely. And this really is because workers are more efficient in a collaborative environment, and there will always be distractions diminishing productivity while working from home. And also this will be compounded if schools do not resume normal schedules at the start of the school year in the fall. Sales work alone as a whole is incredibly difficult from an office, let alone a residence. This doesn't even touch on the psychological implications for a web-based workforce and the lack of live social interaction. There's actually a great article by Henry Blodgett, who's the founder of Business Insider, called Facebook's Remote Working Plan is Doomed. There's a passage that really captures the complexity of the work from home theory. To paraphrase, the article mentions how the experiences of people who reap populate headquarters versus people who stay at home is going to rapidly diverge. And companies are deluding themselves if they think they can crush the human desire for social connection, creating networks, and developing reputations. So CFOs who think they can cut rent entirely will undoubtedly pay for it in other ways. Another theme you might be hearing is large-scale downsizing. So actually recently, Eric Schmidt, who's the ex-CEO of Google, said that there will be more demand for office space, not less, because people will want more social distancing. Blackstone has actually published saying the same thing. And the data in our portfolio shows that people actually want more space, not less. In the past decade, a lot of tenants have moved toward efficiency in terms of space. Things really are as tight as they possibly can be from a density standpoint. So there is a lot of room for people to take more rather than less office space. And if you are looking for more space, the best value you're going to get is in our type of Class A asset, but in the Midwest, in the Southeast, in secondary markets, rather than gateway cities, where you are paying much more on a per square foot basis for the exact same quality. And instead of having a large headquarters in a gateway city, we will likely see regional offices. And the markets that we're in will likely benefit from the decentralization of workforces. And just more on the suburbanization trend and what's going on in gateway cities, there's actually a recent Wall Street Journal article entitled, "When Workers Can Work Anywhere, Why Do I Live Here?" And the article basically talks about the takedown of gateway cities and workers in gateway cities. And it applies to these cities where employees have a very high cost of living and housing, and they have to make high salaries, cities like New York, San Francisco, LA, Chicago, and Boston. And people are starting to wonder, if I can work remotely for the time being, why do I live in San Francisco and New York? And apartment rents in San Francisco are down 9% year over year. And these markets have growth built into their price. You aren't buying a 2 or 3% cap rate because you think rents are just going to stay that way. And when rents go down, this has a huge effect on the value of real estate. In fact, in gateway markets, we've heard stories about New York City office leases getting done at 30% discounts to just a few months ago. Meanwhile, there was another Wall Street Journal article in June, House Flippers Discover Cleveland, a market we're a huge landlord in. In contrast to the rents in San Francisco crashing, housing prices in markets like Cleveland are going up. So there's a great deal of evidence showing the shift from gateway cities to non-gateway that might benefit us long term. And these themes are true to some extent, but required a nuanced approach, especially when comparing gateway to non-gateway markets. The gateway markets really are taking the brunt of it. They're more expensive compared to non-gateway. They have in non-gateway markets, there's a much lower cost of living, lower taxes, and honestly are incredible markets for people.
Mm-hmm. Yep, great points. Camilo, any changes in your overall strategy and operations as a response to COVID? And maybe you can talk a little bit also about why you decide to have the direct investment structure, as opposed to the typical debt fund structure.
Sure. With all this stress and with all this crisis, we think it was a good decision that we, with my partners, we made a decision when we created LinkBased not to create a fund or some funds, but to do a deal-by-deal structure. And normally when everything goes well, that seems a little bit inefficient because it's easier to manage a fund and it's easier to diversify investors in different alternatives. But we decided since the beginning that we wanted to offer co-investment opportunities, deal-by-deal opportunities, where the investors retain the control on where they want to put their money, if they want to participate in a deal or not, understanding how much money we as company and as partners, we co-invest in each deal, so they feel comfortable with 10, 15, 5%, 20% of the deal that we have a skin in the game, as we normally say. With the crisis, we think that was the good decision because every investor that we have understands what is the worst case scenario, what is the plan and the deal with each of the transactions that they are invested in. Some of them are working really well, some of them are having issues, but overall they understand where their money is. and what we are doing in each case to deal with the crisis. So we are not changing that strategy. We are not changing that modus of operation. What we are changing is that we are looking to get more access to institutional investors, to more professional investors, to US investors, for example, that have a different risk approach, and that under crisis, like right now we are having, don't take decisions based on fear, but take more rational decisions. And I think that's a change that we are working in. That's a strategy that we've been trying to implement in the last 2 years, but that we're going to increase now, because we think that we have good products, good operations. There are going to be a lot of opportunities after all these finishes, but we think that the strategy of only getting funding from individual or family offices, single family offices, limits the possibility for us to grow and to take advantage of the opportunities. So that's a change that we are implementing, not just because of the COVID, but it will be increased because of the COVID to access institutional investors, multifamily office, and other digital platforms.
Okay, I want to give Renato a chance also to talk about this. So changing strategy based on COVID.
Yes, we're seeing opportunities in distressed debt, for example. I think there is some mostly in mortgage-backed securities. I think there's great values in it's a sector that was really affected, and there are good properties that can offer a good loan to value for these assets. We're doing multifamily. I think multifamily it's a very resilient type of asset, and we've been doing that. I think it's not going to be affected as much. I think still we have almost 35% of households that are still renters, and the vacancy it's pretty controlled. I think it's we like mostly the lower income, the multifamily on the lower income side. We're still doing some bridge loans. I think there's still some good opportunities. You have to be very selective, of course. Have to look for good loan to values and good locations. And also, as I said before about my what I'm thinking the impacts, I on the positive side, I think we're gonna have good opportunities on logistics, because I think with the increase of the e-commerce, I think there's gonna be a demand for warehouses. I think also senior living, it's a theme that it's gonna be very much in fashion, let's say, very much in because the aging population. And what else? And we like also the 5G, the data team, but it's I think it's a little overcrowded. I don't see opportunities in that, as I see in other things. But mostly, I think distress that I think there's a lot of things going on, and if you be selective with good managers, I think you can find really good returns.
Perfect. And Renato, that was a perfect segue now into maybe shifting gears now to outlook and opportunities. And we'll take the opportunity also ourselves to answer some of the questions that came through. And I'm going to combine two of them here, which is, what do you see as the top real estate asset classes? Which ones are the losers? Which ones are the winners? and what do you see as opportunities? One of the questions here talked about, you know, pro and college commercial real estate, and how some asset classes like golf courses seem to be faring pretty well during this time. Maybe Lisa, you'd like to take that question first? So top winners, losers in terms of real estate asset classes, and overall opportunities.
Sure. Yeah, so I mean, I kind of touched on this in my last answer. I mean, we're focused on sort of middle America, secondary and tertiary markets, which we just happen to really like the markets, but that's where we can find a lot of value. And in real estate investing, a lot of value is made at the buy. So, I mean, we're going to continue to find office opportunities. There's a few different groups that we're focusing on. I don't know if we want to move it to question 3, but I know that we were going to talk about where we see some of the opportunities upcoming, which I'm happy to get into. I don't know enough about golf courses. Honestly, it's a little bit out of our expertise. I would agree that industrial and logistics is faring very well during this time. I mean, obviously, in times where you, at a point it was very difficult to get to the store, obviously, you know, that particular asset class is doing well. And obviously, retail has really taken a huge hit, though. In general, malls at very low collection rates. But these are just areas that we have really not specialized. So I would continue to say that we are very confident we're going to be finding great office opportunities moving forward. And I can launch into like exactly sort of from what groups and whatnot, but I don't know, are we going to focus on this particular question, or should I kind of move into that?
No, if you like to move to that, that's totally fine. We have about 8 minutes left. So now just keep in mind to give everybody the opportunity to speak.
Yes, of course. Yes, so if anybody else wants to answer that question, go right ahead, but I can also talk about some of the groups that we're targeting.
Sure. Opportunities in the lending side, I think is going to be really interesting because banks are really slow right now. So I think there are going to be a lot of opportunities doing good loans with good sponsors and good properties that normally will be bankable loans. But because of what is happening, banks don't move fast enough, and I think we rich lenders, private lenders can fill that gap and can find really good opportunities. Non-performing loans, everybody's looking for that, but I think there are going to be some opportunities to acquire some non-performing loans and deal with the sponsor or work with the property. Vacation homes, we think that even though the hospitality industry and the hotels industry is having a really hard time, so depending on the location, vacation homes or second homes are going to have are going to be a good opportunity because people don't want to stay forever hiding in their homes or in their condos. So I think people wants to go out and wants to travel. And maybe a safer way to do it is through a second home or vacation homes. Repositioning retail assets. Retail is having a really difficult time, and a lot of tenants are filing for bankruptcy. A lot of tenants are leaving properties. So we think there are going to be opportunities repositioning retail assets in the right location with the right partners that have the experience and the capabilities to do it. And for us, as we say it, having the flexibility of doing the bridge loan in the lending side, acquiring the property and or partnering to develop the property, we feel that flexibility gives us an opportunity to find good deals with good people in the right location and at the right price.
Great, thanks, Camilo. Eric, what would you say, you know, given what Camilo just said, you know, as a developer of hospitality real estate, so what's the outlook?
Yeah, I was actually going to piggyback off of what Camilo was saying, because I think I would say winners are single family homes and multifamily to an extent. And as Camilo put it, vacation homes or second homes. And I think beyond that, I would focus on the geographic region as a key factor, because I think there's an obvious realization of people who were used to going to the office every day, whether in Manhattan or other gateway cities. And they're now realizing that, oh, I can work from home. I can get this done. This is working. Maybe I can, go live in Florida or Puerto Rico or somewhere where there are tax benefits to living there, and I can actually have that financial advantage to doing so, get my work done. Or if it's personal preference with their families to get away out of the city into the countryside, there's an obvious trend to spend more time outdoors and have more space because of COVID.
Yeah, absolutely. I live in New York City, and it's definitely crossing my mind. Renato, how about you?
Yeah, I think the same. Yeah, it's multifamily and the stress that I said before. It's a much more difficult, way to invest. It's not easy to find the right. It has to be very selective. But I think multifamily is the most resilient one today, and I would look for opportunities there.
Okay, fantastic. So we have about 3 minutes left. We do have a question here. Actually, they came for Camilo. Do you lend your own money, or do you work with external financing sources?
We have three sources.
Right.
First one, our own capital. That's why we co-invest in every deal that we do. We co-invest with other investors, normally family offices, multifamily offices, and high net worth individuals. And also recently, we have a line of credit that we can use to fund some of the loans. We only use that one in the lending side. But typically, we do private money from investors and our own money to co-invest with them.
Fantastic. And the other question.
There's something. Sorry, Eduardo, something that I think it's worth mentioning, and that I think it's good for everybody. It's about the interest rates, right? That it's probably gonna keep low for quite a while, and the refinancing it's gonna give some much more room to better returns for the investors, right? In general.
Yeah, absolutely. Another question that came through here is an open question. Whoever would like to take it. From your experience and track record, when do you consider we're going to see the U.S. real estate prices reflecting the crisis consequences? Any takers?
I think that's the $1 million question, because nobody knows, and each asset class is different, and as you know, in each asset class, every market and submarkets are different, and that's part of the difficult analysis that we all have to make. Are we going to see prices going down 10, 20, 30%? When is that going to happen? I think everybody is on the sidelines waiting for that to happen, getting a lot of liquidity to be able to get the best opportunity possible. But I think nobody knows how deep is going to be the crisis, how affected the prices are going to be, if there are going to be huge opportunities or not, and if we have to wait 2 months or 6 months, or is now the moment to buy. That's why, as we say, deal by deal, case by case, you have to do your analysis and deal with what you know already. We cannot speculate. We cannot forecast. Nobody will forecast what is happening now. So you just have to analyze the opportunity, analyze the market, do your projections, and run with it.
Yep. That's situations like this that really highlights the importance of your own expertise and the quality of your, credit standards. So with that, we've reached the end of our allotted time. Thank you for submitting the questions. In the coming days, I think we covered all of them, but in the coming days, if we didn't answer any of your questions right now live, we'll get to those, okay, to you separately. We thank you for your time and participation today. Please join me in extending a warm thank you to the panelists, Lisa, Eric, Camilo, and Renato, and to Flya for organizing another insightful event. With that, Mike, back to you.
Thank you very much, Eduardo. Thank you, Eric, Camilo, Lisa, Renato. Excellent close for the day, and very interesting insights. And Eduardo, you didn't make their lives easy today. So we appreciate you very much for moderating this panel and providing really interesting insights into what is going on. Rain, with that, will you please take over and close?
Sure thing, Michael. Good afternoon, everyone, once again. Thank you for joining us today for Flya's Real Estate, Direct Lending, and Private Debt Forum, Part 5. This is day 1 of our 2-day event today. We would like to thank our sponsors, Nationwide, Allagash Partners, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Off the Chain Capital, and Clarion Asset Management. We would also like to thank our panelists today for providing their expertise and commentary. It was another great day of expert insight. We hope you join us tomorrow for day 2 of our Part 5 series. Thank you very much and have a great day.